right, y'all, and we are supposed to be live, broadcasting only on onedealaway.com/live. However, well, I've been busy this weekend and decided that I'm going to start doing some stuff with Bitcoin and program with it, which requires me to download a full-blown node. And it's been downloading for a while, and I am still in 2018. It's been downloading overnight, so it's gonna be a while. It's gonna be a while, and unfortunately, it's taking a lot of the resources when it comes to the internet, and so unfortunately, we're not able to do the show live. But I did message everybody who was on the show, and I did explain what was going on, and I did explain that hey, I'm gonna record this puppy, so I am recording it live. You're not watching it live, and we're going to talk about stuff, and I'm gonna post the video. So my apologies for that. It was supposed to be done, I guess, yesterday, but I didn't realize of how many resources this is taking. And good news is I have crossed over a 50% threshold. So this is exciting. It's been downloading for about 24 hours at this point. And so, yeah, it takes a while. It takes a while to do it. And I'll be glad once it's done, but for right now, it's a pain in the butt. So, what are we going to discuss today on the Money Matters show? Well, we're going to be talking about, like what is our collective view of the money and what is the future of money going to look like. We're going to be discussing a bit of, great reset. Is it happened? Is it about to happen? Has it already happened? What are the things looking like? We're, of course, going to take a look at some of the predictions from Morgan Stanley and what they're telling us to do versus what we're seeing things happen. We're going to be talking a little bit about German banks and kind of what's happening there with their zero interest rate policy and how it's actually affecting regular mortals like you and I. So, as you can see, we're going to be covering quite a bit of a ground today. I do want to welcome you for watching this. I want to thank you for watching it and for listening because we do have some audio only members here as well. And I do want to welcome you as well. I hope you're enjoying the show. Let's do this. And good morning, happy Monday to you. I hope you have a fabulous Monday. We have just crossed over a second part of November. Thanksgiving is around the corner, although it sounds like most of us are not going to really have a Thanksgiving, at least not the way that we used to at one point in our life. Like a year ago, or 2 years ago, 10 years ago. So, anyways, COVID is changing everything. It's changing how we do business, it's changing how we do holidays, but that's just kind of how things are. Now, let's get started. Let's jump over to Germany first and talk about it because I think it's going to drive a lot of sort of understanding of where maybe the rest of the world could go. I'm not saying the world follows Germany, although, at times we do, but I think it's very interesting to understand what's happening with the zero interest rates. And here's the news that kind of came through that says 300 banks in Germany charge negative interest rates, including Deutsche Bank, Commerzbank, ING, to their customers. So what happened? Well, banks in Germany have been increasingly passing on the burden of negative interest rates to their clients. More than 300 financial institutions charge some of their customers negative interest. Almost 200 of them impose negative interest rates on private customers, and the rates and terms vary by bank. Almost 30 banks and savings banks have introduced a so-called custody fee. So they are basically not calling it negative interest rate or penalty or any of that stuff. They just say a custody fee, right? I mean, that sounds so much nicer than saying, hey, we're going to penalize you for holding money. We need you to spend it. Spend. So they don't do that, right? But that's really what it's designed to do. Now, Commerzbank, BNP Paribas, Deutsche Bank, there's a slew of the banks all applied 0.5% fee, right? Negative interest rate, but it's basically 0.5 custodial fee, as they call it. And then there's one bank, Bank One SAR, charges 0.75% on accounts of 100,000 euros or more, and that's the highest one that there is. And it doesn't sound like a whole lot of money, but when you start accumulating it, I mean, it adds up. It adds up very, very quickly. And so the latest major bank to start charging their customers a custody fee of 0.5% is ING, which will be charging their customers starting on February 1st, 2021. Of course, this all comes from the zero negative interest rates that are passed on from the central bank down to the bank, and the bank is like, why are we paying stuff? We're just going to charge our customers. And that's kind of one of the things that I always keep bringing up in this show, in every conversation, every public speech, every class that I teach, or everything else, that whenever you start thinking, the people are very short sighted often. We, as sort of customers, consumers, however you want to call us, very short sighted that, things just sound really lovely at the surface. You're like, yes, charge the businesses. Well, the business is going to pass it on to the customer. At the end of the day, you and I will pay for it. And here is basically the case that is happening right now in Germany that is really showing that that is true. The president of the association warned that more banks will be forced to charge their customers negative interest rates as they are being charged. Now, what is one of the options? Well, obviously, the most, I guess, nuclear option would be leave Germany. Right? Leave Germany, bank somewhere else, which sounds lovely, but you really can't. Many banks won't open a bank account for you unless you're sort of like there and have a reason to be there, kind of thing. So it's not necessarily as easy. I mean, there are some neobanks right now, online banks that exist, but again, it makes it a bit more complex when it comes to sort of the cross-border foreign stuff going on. And just last weekend, I actually did a blog on onedealaway.com. If you go actually to the number one, dealaway.com, you go to the website right there. You're actually going to, scroll down a little bit. All of the blog stuff posts right over there, so you'll be able to read it. But just explaining my own personal family challenges with the whole like banking industry stuff. The other option, of course, is you can just go into the crypto. The somewhat scary part is that it is volatile. It goes up and down in value, but the good news is that there are some stable coins. It's still not 100% certain, but then again, what is banks can sort of do what they want. Governments can do what they want. They go up and down, under, over. So it's just new kind of risk. It's a different kind of risk, but it's a risk for all of that stuff. I guess you can hold your money under your mattress, I guess, but that doesn't make sense either, because now you are, exposing yourself to a risk of somebody, breaking and entering and stealing all of that stuff. So again, everything has a risk. Everything has a risk. You just kind of have to decide for yourself which risk do I want to be part of, which risk I don't want to be part of. Now, one of the things I also wanted to point out today is that even though it's not Thursday, and Thursdays we do real estate, there was something that kind of popped up that I thought it's very timely. We need to talk about it right now, and then we'll do a full-blown explanation in what's going on in real estate. And here is the article. Mortgage rates are rising. And yes, we've explained that in the Thursday show. I believe we explained it in the Thursday show. Because they're connected with the treasuries, treasuries went up, that means mortgage is going to go up. So we've expected that that is going to happen. But here's basically what happens. So it's not necessarily as scary as the title says, right? Basically says right here, quote, rates last week averaging 2.84% for 30-year fixed rate. Previous week, all-time low of 2.78. So it did go up about 6 basis points, so 0.06%. Monday's announcement from a drug maker Pfizer made the bond yields jump, And then, of course, mortgage rates followed, just like we talked about on Thursday that it would happen. 15-year fixed rate mortgage rose to 2.34%, up from 2.32 a week earlier. So 2 basis points. So nothing huge, nothing for you to be like super panicky, but I did want to share it with you so that you are aware that this change is kind of coming, right? And of course, now we're seeing closures and everything else. And we're going to talk more in detail on Thursday. But of course, you are fully aware that we're about to expect some changes when it comes to the economy, when it comes to buying, selling, attending, as well as real estate transactions. Okay, so here is the interesting piece that kind of was shared by Morgan Stanley. And they're saying, go and risk everything you got, trust the recovery in 2021. And they're basically saying, it's going to be a worldwide rally. You should go in and get yourself into the stocks. This is going to be amazing for you. So here's what they're saying, right? Morgan Stanley strategist said an expected V-shaped economic recovery, greater clarity on COVID-19 vaccine, and continued policy support offer a favorable environment for stocks and credit next year. In an outlook for 2021, the team basically is recommending investors overweight equities and corporate bonds against cash and government debt and sell the US dollar. They're saying, quote, this global recovery is sustainable, synchronous, and supported by policy. Keep the faith, trust the recovery. So, will the recovery happen or not? I have no clue, y'all. I have no clue, but what I do know is what this article over here says to us, and that is that in about a month, a little bit more than a month, but in about a month, 15 million Americans, plus minus, will be facing devastating loss of pandemic stimulus the day after Christmas. So if you are paying attention to stuff, you know that we have a lot of people on unemployment. Every week the numbers are announced. They're always much larger than everybody anticipated. I mean, they're not in 30 million people in 1 week like we saw in March. Okay, it wasn't 30 million, but it felt like it because it just went right through the roof. I mean, there was a chart over here and then boom. And you were like, where did it go? Where did it go, George? So, so it's not happening at that scale, but still, people are being not as hired as quickly, even though there's some areas that are definitely hiring. So it's not like complete freeze, like nobody's hiring. But a lot of the stuff is, folks from the industry sector that is like retail, hospitality, that kind of stuff. There's really no jobs over there. I mean, more and more things we're seeing of things closing, malls going bankrupt. Simon, of course, is buying some of them. There was just actually an announcement that they're going to buy some sort of mall, I want to say in Twin Cities, maybe. Maybe I'm making things up. Maybe Detroit. I don't know. No, actually, Detroit. Somebody bought the mall in Detroit, and they're actually looking to get a permission to turn it into housing. So they're going to take a mall and basically flip it into apartments. We've actually seen that here in Rhode Island. The oldest indoor mall, it's really tiny, but it's adorable, actually has microloft units. So it's a 3-story thing, and second and third story are basically microloft apartments, and still fairly pricey. I mean, you are looking at 200 square foot for about, I don't know, 800, 900 bucks a month. So it's still pretty pricey, but they exist. And then the ground level is the restaurants and shops. Now, I haven't been there almost a year now, but it is there and it is existing. So it's not like unusual thing to see happen. And who knows, maybe that's what Simon is planning on doing stuff. As you know, they are one of the larger owners of commercial real estate, and they have their own REIT and stuff, right, that you can invest in if you wanted to, which I don't know why you would want to invest REITs right now because they're all commercial property, and we know commercial properties are crashing. And if you don't know about it, and if you haven't seen the video and you haven't listened to the show, well, what you want to do, you want to go to YouTube and find Money Matters with Nev K. You're going to go into the Money Matters broadcast piece, and you're going to go and look in for a Big Short 2.0 video where I go in and explain everything about the whole thing and how we are potentially at the brink of a Big Short, right? The movie 2.0 with the commercial real estate, and I think some residential will kind of come with it, anyways. But so there's problems there, right? There's problems with millions of Americans that whatever little bit of extra stimulus that they had expires right after Christmas. They can apply then for emergency funding, which is going to kind of extend them for about what 12, 13 weeks, which could put them right at the brink of enough time for maybe whomever the president is in 2021, because it's still very contested, heavily contested. Uh, maybe they will roll something out. I have no clue. I don't know what's going on. But that's kind of where we are. The other pieces that are also ending, not right after Christmas, but it's right after New Year's, are the forbearances are rolling over. We're going to see the rent, moratorium is going to end. So if you have a tenant that is saying, I'm not going to pay you because CDC says I don't have to, well, you have basically a month to wait. And so, you can go ahead and start getting your paperwork in order. And I know many, many landlords will do just that. And of course, the renters will still owe the money. Now, good luck potentially collecting it. I don't know if you're ever going to get that or not. So sometimes it's just cheaper and easier to write off the loss and move on with your life, getting the deadbeat out of your place. But that's just my opinion. Then, of course, what else is happening in contrast to Morgan Stanley saying, no, 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 you got to keep on the faith. Well, here is another news that is coming in that new panic buying and short COVID cases surge. So get yourself ready for another sort of missing TP from the shelves. Retailers report that consumers are again loading up on cleaning supplies, paper products, canned food, and other items. And it means another run on toilet paper. So if you haven't purchased toilet paper, maybe right now is the time to at least buy a little bit. And of course, there's going to be some that are going to start price gouging. Amazon apparently, reportedly, is chasing those folks off of its platform. But if you don't have it and you really want it, I guess you will buy the things. What are the other things that are also going up in sort of like being really purchased right now? Well, exercise equipment, as gyms are closing down. Folks are starting to purchase, the treadmill machines and free weights and that kind of stuff, outdoor gear. So, gloves, hats, of course, all of those things make sense, like whatever outdoor, like running winter suit, if there's such a thing. Home appliances, they are actually, saying that home appliances will create potential shortness in it. And so if you are in the projects, not like living in the projects, I mean like in the project of like doing stuff with homes and stuff, you might want to pay attention to home appliance stuff, if you need it and kind of space yourself out, so to speak. Morgan Stanley also is joining JP Morgan Chase and Company and Goldman Sachs Group Incorporated in painting a positive outlook for equities. The team doesn't expect a smooth path towards noted and significantly challenges return, including higher than expected winter version of the wave of the beer overflow and the return to austerity in longer term, according to their note. So, never mind that everything else is also imploding. So, how is it going to go? I have no clue. I just know that hope and pray are not a good strategy. And so, keep the faith. I got all the faith in the world, but I don't trust y'all. So, there goes my faith. There goes my faith. Now, there's some other articles, since we're talking about money, that I think are very important and very telling. That kind of, I think, paint the entire picture of what's going on and sort of this stark difference of what's been happening. And I think it might explain some stuff. So let's talk about it. The shift to digital forms of currencies is inevitable. This is a quote declared by PayPal CEO Dan Schulman. Another quote continuing on. Bridging it with it, clear advantages, not disadvantages, clear advantages in terms of financial inclusion and access, efficiency, speed, and resilience of the payment system, and providing the ability for government to distribute and disperse funds to citizens quickly. Daily life will return to something more normal, of course, following the potential vaccine showing up at some point in the future, which is, by the way, I got to pause over here. So, as I was scavenging the news this morning, I found something very interesting. So, Pfizer announced the whole, like, we think we have a very viable vaccine, 90% efficiency rate. We're still sort of testing it. And there were two different articles announcing on the same thing. One of them said, super exciting, we could actually have full blown vaccine working and eliminate COVID completely by December 2021, so 12 months. And then the other article, which sounded much more positive, I'm like, okay, it's 12 months, but it's like there's a light at the end of the tunnel. The other article explained the exact same thing, exact same story, but the title of the whole thing says Pfizer announces do not expect vaccine or a removal of COVID anytime in the near future. And I'm like, well, yeah, I guess depends how you define near future. If it's a month, then don't expect it. But near future, I think for most of us is like 1 to 3 years, right? I don't know. Let me know how you think. I mean, only in crypto is like near future, like next 15 minutes. You know what I mean? So in real life, like near future is 1 to 2 years. Like that's fairly near. So, anyways, it was an interesting piece. I just wanted to mention it out that how same news and different title gave a completely different picture to what was going on. But let's continue with our article. And the article continues with, quote, but what will never return is the way that we once looked at money. Coronavirus was the final blow to our collective notion of money as something real. After agonizing for years about the deficit and everything else, well, the Treasury decided to just write a giant old check for $3 trillion from the central bank and basically distribute it to ourselves. The world didn't end. Dollar didn't collapse. Interest rates remain low. Inflation remained low. Stocks, of course, went up. And the rich got richer. The governments will disperse funds to citizens quickly and digitally in the near future. And I agree with that. A dollar in a decade's time will be worth a fraction of what it's worth today. That's another fact. I also agree. And here is some of the sort of historical things that I think are very interesting to really look in the whole picture. Britain was the first to devalue its currency in September 1931. Everybody else followed. 1929 market crash worked through the system. Of course, it was a giant blown, that happened, or depression, and the governments basically feared that without an anchor like gold, citizens would easily and quickly lose their faith in a pretty piece of paper with some random numbers and dead presidents. Okay, not everybody has dead presidents. Some have like beautiful bridges or birds or historical characters, maybe famous authors and rulers and kings and queens and that kind of stuff, right? But in 1933, FDR abandoned the gold standard and outlawed hoarding of gold. We all know that. Dollar fell over 10% relative to European currencies that had already devalued. And in 1934, FDR reset the price of gold from $20.67 per ounce to $35 an ounce. Each devaluation helped the U.S. expand credit, stimulate trade, and reflate the economy. Gold prices were then steady for 38 years, but the imbalances grew quietly. In 1971, Nixon ended the convertibility of the dollar to the gold at the $35 an ounce rate. And of course, what did we have? Well, we started having a free market flotation device that just happened. And who knew that I would actually use gold as a flotation device? Probably don't do it in water. Financially, maybe. In water, don't do it. You're definitely sinking. And if you have silver, you are absolutely 100% sinking. That thing is very, very dense, and those puppies are very, very heavy. By 1980, the gold that traded at $35 an ounce 9 years earlier hit a high of $875 an ounce. Today, gold trades at $1,889 an ounce, hitting all-time high. What about 6 weeks ago, something like that. So this is a cool article because as we've been talking about sort of the changes and what's happening, I think a digital economy is coming and the money is changing and stuff. I think that this is sort of like an important piece to understand that we didn't go off of a gold standard for the width of it, right? It was so that we could preserve our sort of standard in the world, right? And there's a second article that actually goes into much more depth. So I think it's much deeper conversation about it, and I think it's very cool and very important to understand. So the Great Reset already happened, and here is what's happening. They're saying, put another way, the elites have cannibalized the system so thoroughly that there's nothing left to steal, exploit, or cannibalize. And it already happened in 2008 and 2009. Now, in a broad brush, the post-World War II era ended around 1970. Prosperity of the 1946 to 70 was based on cheap oil controlled by the US and the hegemony of the US dollar. Of course, the abandonment of the gold standard in 1971 was the only way to maintain hegemony. As the global economy expanded, the only way US could send enough dollars overseas was to run trade deficits, which in a gold standard meant the gold reserves would go to zero as trading partners holding dollars would exchange the currency for gold. So the choice was give up the reserve currency and the hegemony of the US dollar, or accept the hegemony was no longer compatible with the gold standard. Of course, it wasn't a difficult decision. I mean, who would want to sort of lose the global power holding thing? So easy thing was to do is to say goodbye to gold, wave, say goodbye, make sure you write, and move on with your life. So the key economic dynamic was the decline of labor force share of economy in favor of capital. So that was the shift that has happened right after that. Those who only had their labor to sell lost purchasing power, while those who could borrow or access capital benefited enormously. There's some charts that we're going to take a look at for those of you that are watching this stuff. For everybody else, I will do my best to explain what the chart looks like, but I think you'll understand it when I read the next section. Labor share of the national income has stair-stepped lower for 50 years since 1970, while the super wealthy's share has outpaced everyone else 15-fold. And so this chart over here is coming from the Federal Reserve St. Louis, the Fed. And you can actually take a look at the chart, which is coming from the Bureau of Economic Analysis. And it's a share of gross domestic income, compensation of employees paid, wage and salary accruals, and disbursements to persons. And as you can see, of course, this chart goes well into like the 50s, and we saw some sort of like a rise to about 51.5. Then it kind of came back down to 49, and I would say this is like mid 60s. Then it hit another high in the early 70s at 51 and a half. Double top right there. And since then, it has been going straight down. I mean, very clear to the point where I would say that this is maybe 2000. It looks like it's a 20 years, so 2020. We are sitting at 43. So we went from 51 and a half down to 43. Now it goes slightly up, slightly down. The lowest was 42, maybe in, I would say if this is like 2008, 9, 10, so maybe in 15, 16 was the lowest. So we have kind of come down up slightly, but it's starting to turn and sort of flatten out and likely turn back lower. The private sector financial assets are now 6 times the nation's GDP, double the percentage of the post-war era. So this chart is actually showing the U.S. private sector financial assets of the GDP, and it goes, again, it goes from the 50s all the way to the 20s, and it mostly goes sideways, trading in this channel. They have a channel marked between 2 point, let's say like 7 to 3.7. but it's actually much narrower than that. It goes from like 2.8 to about like 3.2 for decades, from the 50s all the way into like, I would say like almost 90s, and then it starts to kind of go up, breaking over the in the 95, and then the 2000s reaches a high, and then in 2008 reaches another high, and now it's like, I mean, the 2000 high was about 4.5, the 2008 was about 5, and now we're at 6.2x. This capital-friendly era was rocket boosted by financialization of the 1980s, technology in the 90s, and globalization in the early 21st century. Top 0.1% first pulled away in the 1980s financialization, then in the early 90s, of course, continued moving on, and then exploded higher as technology fueled capital leverage and exposure to the gains. And here is a chart that is really showing the disparity between the top 0.1% all the way to the bottom 90. So top 0.1% earning grew 15 times faster than the bottom 90% earning. And again, it goes from 79 to 2017. So this is what the chart is looking at. And they all start at the same point. And then you have 0.01% top, the wealthiest of the wealthy are up basically 342.2%. Then top 1%, that's just the wealthy, are up 157.3%, while the rest 90%, the bottom 90% basically goes flat into the 80s and 90s, goes slightly up in the late 90s, and then continues going basically flat and reaching a gain of 22.2%. So we're looking at 80s, 90s, 2000s, 210s, 220s. So let's say 40 some years, 47 years over here, 48 years, something like that. We've only gone up 22.2%. That's like nothing, right? Because if you take into the account that inflation was perhaps 2% per year, and what do we take? We have what? Let me see if I can get my handy dandy calculator really quickly. Let's do this right now because I am actually curious. So 22.2 divided by 40 years, you're looking at 0.5% increase per year. But then, of course, you have, say, 2% inflation, which is what they were saying. So it could be right or wrong, but let's just take it because I have to have a number. That means you lost wage on year of 1.5% every single year. Your wage, actually, the purchasing power of your wage has gone up in real terms. That is ridiculous and insane. But let's continue. These extremes are not stable or sustainable. The income of the top 0.1% took a hit as the dot-com bubble burst, but then China's entry into the WTO saved the day. Dual extremes of financialization and globalization created the 2008 bubble, and its collapse almost took down the entire global capital house of cards, financed by the Fed and the tune of $29 trillion, which was instituted as the Great Reset under the unusual guise of emergency measures, which were supposed to be temporary but then became permanent policies. Central banks coordinated unprecedented money printing and financial repression, which includes zero interest rate policies or ZIRP, as the debt bubble would pop if the rates aren't nailed down to zero. And so now this is bringing the whole story of what we've been talking about and kind of how we started with the Germany charging people negative rates. So not only are you getting charged custodial fees to have your money, then your money is actually being devalued through the inflation and additional printing. Then your labor piece, you're basically, as we have uncovered, you are losing actually what, 1.4% on a good year every single year if you are just working. So what is the solution here, right? What is the solution? Well, I don't know. I am not a magician. I don't know how exactly things are going to work out. But I am reading this article and I'm going, wait a minute. How did they become wealthy? Well, they didn't rely just on the labor. Remember, it was the capital and it was the holding of the assets. So many of us focus on the income, statement, so to speak. If we're starting to go thinking a little bit more businessy, right? Of how much money am I getting? How much money am I getting? Most of us don't even pay attention to the expense side. It's only the income side of the thing. So it's not even the whole income statement. But I think people are getting smarter, and so they're starting to pay attention. Wait a minute, income and expense need to play out, and of course, my expenses need to be, below the income, which is nearly impossible to do when you're not getting paid enough. But when people were getting paid enough, vast majority of people were doing that thing, right? They were paying down debts, they were investing in assets, and so people were doing the smart thing. But the challenge is people are not getting paid enough, right? Because as we've just seen and heard, is that the labor force payments are basically negative. I mean, okay, it's up 22.2% in 47 years, but when we take rate of inflation and everything else, it's in real terms, you are basically down 1.5% every single year when you're in your sort of income component, right? So what do the rich do? Well, they focus on the balance sheet. They go out there and they get assets and try to fill the balance sheet with as many assets as humanly possible. What are the assets? Well, they're the things that actually hold and grow in value. But I also want to point out that the true meaning of the asset also is something that is actually throwing the cash flow to you, preferably in a passive way, right? Because it's an asset, it's kind of doing its own thing. So an asset, for example, would be income producing real estate is a great example. A business that you don't work in, but you have invested, that now they're actually paying you some sort of dividend, or some sort of like return on your money. So like when you buy a bond and you're getting money, you lend money to somebody and they're paying you. That's an asset right there. Having a high yielding savings account is an asset. Equity that actually is paying you some sort of dividend is an asset. So all of those things would be considered assets, right? And that's where basically the rich are going in, and that's why the rich are getting richer. Let's finish with the article. The hyper-centralized global money control has run out of rope as chaos, as not chaos, as cheap oil is gone. Debts have ballooned to the point where there's no way they'll ever be paid down, and the only thing saving off collapse is money printing, which has its own demise. And now we're faced with Willie the Coyote moment of truth, where we've been running so fast, realized we're over the cliff, and now there's that brief pause before the calamity comes in. And with that, I am going to end today's show, today's episode. Again, my apologies for inability to go live due to my little note thing. Let's see how we're doing. Oh boy, I'm in February of 2018, in early February, and I was in mid-January when we started the show. So I think Node is going to take a little while longer, but we should be good to go by tomorrow. And I'm actually kind of excited to start doing some stuff with Bitcoin and potentially start offering it as a form of like a payment and that kind of stuff on our website. So I'm excited to be able to do that stuff over the upcoming days and weeks. Hey, if you have enjoyed the show, if you have learned anything new, hit me up. Make sure you hit the thumbs up, please, and thank you. Do subscribe. Do hit some sort of notification if there is such a thing. And I will see you tomorrow. Hopefully, fingers crossed, hopefully live. Hopefully this note is going to download and you and I get to hang out. Thanks for watching. Until next time, stay forever money blessed. And do remember, you are only one deal away.